So Carbon13 is the venture builder for the climate emergency. Most startups that we work with do B2B. Over the last 2.5 years, we have created 150 startups. And we only invest in a small percentage of those, in 65. £7.5 million, let's say about $10 million. And we take just under 10% equity for that.
Only do equal shares.
We make somewhere between 6 and 12 investments per cohort.
Not do equal shares, never.
It's $12 trillion. So, it's not $1 billion market, it's $1 trillion market. But for about 10 years, the company grew to 120 employees, 10 million ARR. It didn't really feel right. There will be a subset of people that will be interested in climate. Wasn't enough for me to do this. We see ourselves as the venture builder to beat in ClimateTech, where we go from roughly 750 candidates that apply to a cohort. It's actually a super exciting time when you have 80 individuals all focused on climate change.
Michael, very happy to meet you on my podcast about venture studios. Can you tell your story, how you came to this idea of Carbon13, its story, and whatever you think is very valuable to say in the first 5 minutes?
Nice. Hey, thank you very, very much for having me here today. Yeah, I mean, I said earlier, we're a big fan of the research that you've been doing, and we actually use it in some of our decks. So we're very, very excited about having this conversation. And actually, I think I'm going to learn some things as well as telling you our story. So Carbon13 is the venture builder for the climate emergency. And it also tells you already where we come from. So we are venture builder. I mean, there's venture studios and there's venture builders. I think there's a slight difference between the two, where the venture builder model is more around a bigger number of startups that is being created. So over the last 2.5 years, we have created 150 startups. So it's quite a lot of startups. And we only invest in a small percentage of those. So we invested in 65. Again, a very big number compared to some venture studios that might do 1, 2, or 3, or 4 a year. So Carbon13 is more akin to the model of Antler or Entrepreneur First, where we run a cohort twice a year in a given location. And from that cohort, we make investments. So to be honest, that's also a bit like how we came into existence. So me personally, I was a founder of 2 startups before, most recently of a software startup, an enterprise SaaS company in London, where we grew from starting in London to having offices in London, New York, Sydney, building enterprise e-commerce software. For about 10 years, the company grew to 120 employees, 10 million ARR. So quite a successful business. But I always knew I wanted to go into ClimateTech. I wanted to build a startup in that space. And to be honest, I was looking for a program where I could find co-founders to build an amazing business in ClimateTech. And I couldn't find one. The only thing that I could find that was out there was Entrepreneur First at the time when I was where I was based in London. It didn't really feel right. The fact that there will be a subset of people that will be interested in climate wasn't enough for me to do this. So I looked further and I actually found my co-founders, Dr. Chris Coolidge and Dr. Nikki D, who are from or based in Cambridge, around the Cambridge University network. And they had this idea of building essentially Entrepreneur First for climate. So we think that similarly to accelerators, where Y Combinator started this accelerator model, and then there was vertical accelerators over time for fintech, for fashion tech, or for retail, and so on. We think that actually in venture studios, there will be this verticalization of the venture studio model. We see ourselves as the venture builder to beat in ClimateTech.
What is the difference between a venture builder and an accelerator? Like, can you say that you are not an accelerator? And there are some reasons for this.
I mean, it's a really good point. I think the main difference is, so both have cohorts, I would say. There's a cohort where you apply and then you have some program, or actually in the case of Y Combinator, it starts with the investment, I believe. And then you go through a program. And actually in my last company, we went through an accelerator at the time called C-Camp, where there was a pitch day, some days of mentorship and investment. And I think the main difference is that in accelerators, you apply as a team. So sometimes as a solo founder, but you apply already with an incorporated business, oftentimes with early stage MVP and maybe even some customer traction. So with Y Combinator, in most cases, people will have an MVP and they will have some idea of customer traction. It might not be revenue, but some early traction in some shape or form. Whereas a venture builder, in our model, and I think similarly in Antler or Entrepreneur First, you apply as an individual in most cases, and you then join a cohort, you do interviews. In our case, there's a written application, 2 interviews. So we vet every single person, where we go from roughly 750 candidates that apply to a cohort to 80 people that join and start the cohort in the beginning. So right now we're actually doing interviews and applications for our cohort 6 in Cambridge and our cohort 2 in Berlin. So we do have 2 locations. And these individuals then start a program, and the first 10 weeks is teaming. So you find your team and you iterate around an idea, and like maybe there's a change in teams, and there's a lot of fun and interesting things that we do with the cohort. It's actually a super exciting time when you have 80 individuals all focused on climate change, all focused on building something now. And there's people from CERN, like nanophysicists from different universities. There's molecular biologists. There's software engineers, AI experts. There's people from sustainability backgrounds. There's people from emitting industries or chemical industries. And then obviously you have often like serial entrepreneurs that are looking for an idea. And this is a super interesting time, the first weeks, where there's so many amazing brainstorming sessions, so many amazing conversations, that I'm often jealous personally as somebody running the program that I can't really take part as much in these conversations, because there is just some amazingly intelligent people that brainstorm together. And in that way, they team and come up often with an idea or refine an idea. And then you have more the accelerator model. I think then it sort of goes into this accelerator where when you have a team, you then incorporate a business, you have validated, or you're validating an idea. And then there's an investment, and then it's definitely more of an accelerator. But I think that's the main difference. We do have obviously exceptions from that rule. So oftentimes, or in every cohort, we have 1 or 2 or 3 teams that apply as a team. So a preformed team, often of 2 developers or 2 software engineers or 2 technical people or 2 commercial people who've decided we want to work on this and we need somebody to help us in this area. That is a sort of an edge case where it's a bit in between the 2, but in most cases, those teams of 2 are still looking for a third co-founder. So that still then makes that same sort of teaming phase a valuable element of the program.
Mm-hmm. So you did it in 3 years, 150 startups.
Yeah, it's been a busy time, but we say that the climate can't wait. So we need to get going.
Maybe you can share something about climate change to make it clear for all, because I cannot say what is the amount of funding needed every year. I remember this huge number.
It's a very big number.
To be invested in startups in order to make it net zero. Why is it so important?
No, let me tell you a different number. So there's a McKinsey report that came out a few months ago on the market opportunity of decarbonizing the economy and looking at the different industry sectors. So buildings, energy, agriculture, and land, and so on. And the total annual revenue opportunity to decarbonize these industries, these areas, is $12 trillion. So, it's not $1 billion market, it's $1 trillion market. And that is like, if we want to in order to stay in line, not even with 1.5 degrees warming, but over 1.5, so somewhere around 1.5 to 2 degrees warming. After which it becomes very costly to the economy, right? Like, I mean, in the UK, last 2 years now, we've had very high temperatures on some days in the summer, at which point the whole infrastructure doesn't work so well anymore, right? Like the rail system doesn't work so well anymore. There's problems with a lot of the physical infrastructure of of our countries, and it's the same in many other countries. So there's like real economy impact on the effects of climate change. On the other hand, you have government mandates and government regulation that says you have to, right? Like as a business in the EU, given the regulation that has just come in called CBAM, the Carbon Border Adjustment Mechanism, you have to, if you want to import materials into the EU, you have to show the carbon impact of those materials or products. And that means it will, and then pay a tax on it as a next step. So if you buy something that is lower in terms of impact, you will pay less tax. So, there's a very strong incentive to buy materials or to buy products that have a lower impact on carbon emissions. And that is in place now. As a business, there's more and more urgency actually to do this. And at no point have I spoken about the human impact on climate change, which will be dramatic in many places, as well as in the whole world. As soon as you have temperatures above 40 degrees, it becomes very difficult for the especially elderly or slightly sick people, to be outside, to have a normal life. And at that point, again, it becomes an impact on our health systems.
What are forecasts for the temperature for the next 2 years, and when it might be really critical?
I think 2030 will be the time when things will, same as a lot of the government regulation in European countries as well as in the US. I guess the US has a slightly different approach where it's more incentivizing through IRA, the Inflation Reduction Act, to incentivize investments. And it's more of a carrot approach to climate. Whereas in Europe, it's a bit more of a stick. There's regulation, there's restrictions, there's things that people need to do. I think they're also rolling out more of a carrot and more investment programs, and every European country has to do that separately though, so it's a bit slower. I mean, China and US, the one thing they can agree on, besides everything that's going on in the world, is climate goals. So there was just a summit between the US and China to agree that, that's the one thing we can agree on. So as a business, that's okay, that as a startup, that's a great opportunity, right? If the one thing that we know globally we can agree on that actually will happen is sort of reducing climate emissions, then building a business in that space is very, very interesting. Climate is a very complex ecosystem, complex system, and in some places it will get, on average, colder because of things like the certain water streams in the sea that actually climatize, for example, the UK, or keep the temperatures on average higher in winter. But if the Gulf Stream is going away over time, then it will actually be colder in winter. But you'll have these in the summer still hotter months than ever before, right? It's the extremes that, both with temperature as well as rainfall and droughts and so on, that become stronger. And it's less so the average, right? If it's a little bit warmer in the summer, up 2, 3, 5 degrees, it's okay. But it's the extreme then suddenly often having a 45 degree plus temperature that makes life quite difficult.
And what is your business model? What percentage of equity do you take? And in how many startups have you invested as an accelerator?
And I should say we have a venture builder model where we have a venture builder program in Cambridge and one in Berlin. So covering the UK and Germany, or the wider DACH region. And some European startups there as well. And then we have an accelerator for later stage businesses that is for the UK only right now. We've invested across those 3 programs in 65 startups, and we take roughly just under 10% equity for that. So again, you have this venture studio model where you have maybe 4 investments per year, where they then take 30, 40, sometimes even 50%, even though personally I would question that size of equity if I was a founder. Our model is more startups, but we only take 10% from each startup, and we then help them raise money. So it's very much a part of the value add is to help the startups raise funding. At this point in time, of the earlier cohorts, about 80% have raised some kind of follow-on funding, if that's equity from VCs, angel financing, or government grants.
80% of those in whom you invested, or from all startups?
Of those that we invested. I mean, the truth is we make somewhere between 6 and 12 investments per cohort. Or 6 and 15. There's a range, right? Like and I can talk a bit more about the funnel that we go through. But of the startups that we don't invest in, I'd say there's always a good number, but not all of them will keep going. Some of them, I think the bigger number is probably not going on with the business. But then, especially here in our German cohort, because there's a lot of government funding for early stage startups to get some grant funding. There's something called the Berlin Startup Stipendium. There's different German-wide support systems where startups can get a few thousand a month per founder to just keep going, equity free. And through those programs, quite a few actually are still going and have then gotten some kind of money and are going. So in Germany right now, I would say probably more than 80% are still, of all the businesses created, are still going and have gotten some kind of grant funding.
Let me understand again. So you mentioned that you have some venture builder or venture studio model also a bit, and also like this pre-accelerator. You call it venture builder, right? The first phase, then accelerator. Yep. And do you have somewhere like your team works together with entrepreneurs, I don't know, doing some marketing? So I understand that you help to raise funding, but maybe there are some other functions. Just to understand, like, do you have this venture studio model or not? Or only accelerator?
No, I would definitely say so. And I mean, I guess there's these different phases. So the program has a phase 0, which is the talent acquisition. So where we find founders for the program, where we then end up with somewhere between 500 and 1,000 applications, 750 on average. We then start with a cohort of 80. That's phase 1. Phase 1 goes about 10 weeks, where we help people find their team and already define ideally at 1 or 2 or 3 ideas, or maybe one that they want to work on, or at least a problem area. So it might be, we want to work on decarbonizing buildings because of the backgrounds that we have in the team. We then go into phase 2, and I would say that's the real phase 1 and 2 are the real venture building, venture studio phases, where you then help people through a mix of experts that we have in our community. So we have a community of 350 domain experts, and those are people from pretty much all technology areas, from academia, from universities, from the startup ecosystem, that can help the teams with, let's say you want to work on hydrogen, then we have some hydrogen experts that will work with you over a number of weeks. Or we have, so that's the domain experts. And then we have, every team gets a entrepreneur in resident assigned. So an entrepreneur in resident, in our case, is an exited entrepreneur that has gone through the building of a startup at least once, or in many cases 2, 3, 4, 5 times. So they get assigned an entrepreneur in resident, and that person meets with them on a bi-weekly basis to really help the team go through, and in the beginning, I guess, it's mostly customer validation and sort of lean customer development, where, because we invest pre-product in many cases, it's more about, is there market need at that point? Is there really like a need from customers? And at that point, we have a set of corporate partners that we also introduce to the teams to help with that sort of validation. EY is one of our partners, as well as Barclays in the UK, the bank, as well as BP Ventures, VW, Arm, the semiconductor company. There's a lot of corporate partners that we have that then work with the teams and help the teams sort of validate these ideas. Yeah, so we work with them then on sort of early product development, but it's more sort of making sure your MVP is defined based on a market need. We work with them on a financing plan, and we work with them, very importantly, on a carbon case. So the carbon case is the team develops the narrative around how they will mitigate carbon emissions. In our case, every startup that we invest in has to mitigate 10 million tons of CO2e, so equivalents, or CO2, from the atmosphere at scale and per annum. So it's quite a big number, but it helps especially the scientists, to think about how do I want to scale the impact of the startup. And that's a very core part where we think if startups think about their impact from first principles and also from the very beginning, they make impact, especially CO2 and climate impact, a core part of the proposition. And, in 10 years' time, when the CO2 markets, I think that's when we see climate change really impacting the economy in many countries. When you are then a startup that has clear sort of ways to show I can mitigate 10 million tons per year, at a carbon price of $100 to $500, that's a unicorn in terms of potential income, potential impact on the economy. So that's a very core part that we believe climate impact, climate performance potential is a very strong future sort of show sign of success. And that's sort of the venture building phase 1 and 2. Then we invest, and then it's probably more acceleration, really going out to do more fundraising, maybe some grant funding and so on.
What do you do inside of this first 2.5 months where founders can meet each other? Like what are activities and programs to do this?
There's a big mix. There's things that are just pure sort of networking, right? Like you have to make sure that everybody meets everyone, and that's quite complicated with 80 people, right? So we have things that are sort of speed networking, where you literally are in a room and one line or one circle is sitting, the other one is moving every 15, 20 minutes. Then there's sort of brainstorming or networking around ideas. So there's everybody writes down an idea, and then they come into a group and they brainstorm and hear each other in that way. We have a theater director from Cambridge called Paul Bourne, who comes in and does some activities with the cohort that for some people like us that are a bit more in their mind, we work in our heads very much. It's good to get them a bit out of that and a bit sort of into this sort of, we're humans, we're physical. There's like activities where you stand up and you do like little role plays, and he does a lot of these things that theater people do, and that's actually, it's really fun, and it shows people a different side of their potential co-founders. We do fun activities in the UK, for example, in Cambridge. Rowing is a big thing. Rowing as a university has a lot of rowing clubs, so we take the cohort rowing. We have a session with the Antarctic Survey where we have some scientists come in and talk about climate change and the actual numbers, the actual sort of science behind it. We do little exercises, sort of sprints around a certain topic. So people would work on a certain idea for a short period of time and then present something. We have a series of presentations that the cohort do about themselves. So it goes from, this is me, and I'm giving a presentation on myself, my background. There's some amazing, funny videos that people make about their backgrounds, and they have, for example, their friends interview themselves, and it's almost like a little documentary. It's all about how do I help these 80 people know each other? Because it's beyond the value is beyond these are the 2 people I want to start with. There's 80 other people that have had senior positions in McKinsey, BCG, in VC funds, in university. And it's not just those 2 people that I want to start with, but it's this network that I can then make my network going forward. And this cohort is a community that is a really important part of helping each other. There's a lot of peer-to-peer learning and help that comes over the period. And we actually do something called the Frank Knowles Prize, where we give a special money prize to the team that helps the other teams the most. And Frank Knowles was an early co-founder that passed away, but he was one of these people that really helps other people. And in that sort of memory, and also generally, but that's an important part for us, is that we want to build a community that people can go back to also 3-5 years later, because it can be really helpful when you start at the same time and you go through the same problems and you solve the same problems, like incorporation. How do you set up option schemes? How do I set up visa schemes to get people on board? How do I set up like my contracts for this and that? Like there's a lot of these questions that actually are the same when you have a cohort-based model. And if you can manage to make them help each other, there's a big opportunity there.
Do people do it full time during this first period?
It's a really good question, and I think it's one of the things that makes us different. So the average age is actually a lot higher than what people think. Do you have something in mind from other venture studios or venture builders that?
No, but I know that some try to focus on really experienced founders. Maybe I would guess that your average age is in the cohort something like 42.
Yeah, it's 38. So 38 years. Okay. So what does that mean? The average 38-year-old. And we diversity is very important to us. So we want to make sure to have a lot more women than the normal startup programs. Ideally, we want to have 50%, 50-50, but it's more or less 35 or so % women. And when you are that age, oftentimes you will have a family. You will already have had a career. You have set up a life. That means you can't just, I'm not 21. I don't want to just move to another city and live there for the next 6 months. Like, when you have kids in high school or in kindergarten, that's impossible. So we set up our program to allow for that flexibility, to allow people that can't just quit everything on day one to do that. So the way we've set up the program, it sort of combines, it's a hybrid program. There's in-person things and then there's online things, and in-person, online. There's a certain rhythm that we have found works really well, especially in those first 2 months, where we can use the strength of in-person meeting people with the ability to actually, not for everybody to have to be full-time in the beginning. So we always have, I would say, 30 to 50% of the cohort who's already committed. They have decided, I'm going to start a business. In some cases, they've already incorporated a business, or they have been working on the business for several months before the cohort starts. And then there's a group of people that the other sort of 50 to 60%, there's a group that freelance work. So they're experienced. They often be able to do contracting, especially as a software engineer. There's the ability, or a designer or product person, you can do like 1 or 2 days a week, and they have this goal, and but they do some work on the side. And then some people are still in a full-time employment, and the point of when they have to quit, or when they have to go full-time, is when we do the investment. So at that point, that's when, so halfway through the program is when people then really fully commit. That's been working really, really well. We get very experienced, I think a lot more experienced people than what other programs that are sort of similar venture builder programs do. So the main thing for us then is to make sure that everybody is in their vision for their life, are committed. I want to start a business. I just need to know there is a team. Just need to know there is a future. And then I will commit, and then I will do this. And I guess in many ways, we see that as our responsibility as Carbon13, is to show you, when you come into a program, look at these amazing people that you should not think about anything else than wanting to start a business then with them. And that's when we alleviate that doubt, maybe, that people go, yeah, but I can't just jump into the dark without knowing there's good co-founders in this program. Yeah, to answer your question, 40 to 50% are full-time from the beginning, and then the rest is sort of a mix between part-time and actually in transition.
Your activities, how many times a week, or how many hours? Like, what is this average schedule?
So the in-person days are full-time. And then that's 4 times throughout the 10-week time period. And then there's online sessions that some of them are recorded, but better when you do them in person. Some of the sessions are at the evening or also weekends sometimes. And there's a lot of things where at that point we give the cohort tools to have the right conversations with the other people. And then, people go for breakfasts every morning with somebody else, or they have coffee calls, or they find time throughout the days to meet the other cohort members and to start the conversations. And then there's the in-person days again, where sort of it speeds up and there's more, it becomes real again. And then it's sort of this up and down. We tend to get a concentration of people close to where we run the program. So in the UK, that's the south of England. So Cambridge, Oxford, London. There's a big concentration there where most people are actually probably based in London and then commute to Cambridge for the in-person days, and they can meet, anyways. Then we have people coming from India, Nigeria, often from other parts of Europe, from the US. A lot of applicants are actually traveling from the US to Cambridge to do this program. And then in Germany, we had probably 50% of the cohort came from Berlin, or was based in Berlin, but actually very international. The German cohort was very international and very diverse. I think across the teams that we invested in, there's 11 nationalities.
Am I right that you said 4 days during 10 months program, or full-time days, or not?
No, it's about 10 days.
10 days. Uh-huh.
In terms of the 10 weeks.
Yeah. And people go for this 2.5 months to visit this 10 days. Yeah. Who can do this? Right?
No, I mean, they come, oftentimes they'll take a train, come do the in-person days and then go back. And so, for example, we don't tell people where to incorporate their business. And yes, it's a Berlin-based program, but we have a lot of teams incorporating in Munich and in Frankfurt and other places. So we don't tell the teams you have to incorporate here. So wherever oftentimes when you have a deep tech, biotech startup, you have a scientist, and a scientist needs a lab. To get lab space is one of the biggest problems, I would say, that we can help with. But it's one of the biggest problems that biotech startups are facing. And one of the ways to deal with that is to stay at your university. So they often stay at the university that they might have done a PhD, and then in that way they can work on this.
Maybe you can share some learnings or hacks or ideas on how to better execute this 2.5 months program. For example, I think that it seems like there is a primary soap when people just meet with each other doing different things, and sometimes some teams oh wow, we have an idea to launch this, so we like each other, we saw each other in different situations, but maybe you had some, I don't know, learnings that you started with one approach, it didn't work, you changed something. So for such types of venture builders, accelerators who are considering creating teams between entrepreneurs, what might be advice?
I think and people often come to us and they go, is that a good idea? I want to do this. Is this a good idea? And the truth is, I don't know. I mean, yes, I do have an opinion, obviously, because we've seen a lot of businesses, but I could perfectly be wrong. And it's not about me liking your idea, but what I would like in the idea is if you show me that there's a customer who likes the idea and who's willing to pay money for it. So most startups that we work with do B2B. I think a lot of our model only works in B2B. Well, not only, but it works differently in B2C. If I know I'm going to sell to this kind of company and there's maybe 100,000 companies, if I speak to 10 and 3 say, hey, this is great, actually, or if I reach out to 100 and I get a response from 10 or 5 and a few of those say, hey, this is really interesting, let's have a conversation. Maybe you can get a letter of intent, or you get some kind of indication that what's the process, or what can we, maybe there's even already a project, a proof of concept that you could do together. I think that's a better way to show that something is interesting than if you say, well, it's for the general public, and I know I need 10 million users, and how many can I speak to in 2 months? If you don't have any money as well, right? Doing a big sort of kind of proof point. So yeah, I think in B2B, that's easier maybe to get the proof points. Is also that's where we have the ability to help a lot, where we have connections to a lot of corporates, a lot of different, having done this many times now, we know, if you want to do something in buildings or construction, these kind of construction companies is where you should, isn't this the person you can ask, and they might be able to give you feedback because they have worked with somebody in the past. And there's this kind of learning, I think, as a VC or any kind of investor, the more the market that you want to invest in, or that the startups want to build startups in, the more you can help, obviously.
My question was a bit about the program, like how to increase the conversion ratio from separate individuals to teams during those 2.5 months. Like, do you see that in 3 years now you do it better than you started it earlier? Or it was ideal from scratch?
I think we have learned, definitely have learned some things. There's an element of like, what do you think? How many people should have an idea when you run a program like this?
I think that maybe 25% go with ideas.
So it's good. You're a lot better than what we thought. We thought, everybody should have an idea, right? And and that's a really bad idea. Like, you can't run a program like this if everybody has an idea, they come in and say, yeah, you work with me on my idea, right? And then you have too many of these conversations where it's like, yeah, but which idea do we work on? And then there's a team and they have 2 ideas from the 2-3 co-founders, and they're completely different, and they don't really get out of this sort of issue. You need a number of people that don't have an idea, that are just like, I'm great at sales, or I'm great at software engineering, or I'm great at this. Yeah. And then you have other people with ideas, and then and then there's an element. I think there's a lot about the type of people that you choose that makes a big difference. I think the main difference is the type of people you get into your program. That's the main sort of variable. Like, if you get people into your program that are keen and open and want to build something in a given space, and they have certain traits that make them somebody that can collaborate and that can work with other people and that can be a good co-founder, you have to give them some ideas. And you sort of, sometimes we give people ideas. We look at them, we look at the team, and we work with the team, right? We go, actually, you've done this at some point in the past. Like, why do you not build something in this space? Like, we've seen this and this work. Or we bring in corporates. Like, last time we had a call with one of the biggest furniture companies in the world that talked about, like, here's the problems that we face in decarbonizing and net zero. And, if you build a business in this space, that would be interesting to us. Or we have an energy company doing the same, or we have, different other corporates doing sort of that, giving that kind of presentation about, here's a space that you could work something out in. There's also finding, I guess it's very different, depends on what kind of business you want to build. Our businesses are quite hardware and deep tech and biotech heavy. So we have to have other support systems that maybe you don't need if you build a software only business, right? I think actually in many ways probably easier to do software than hardware because of the timescales, because of what the companies need and so on. So you need different partnerships. You need support systems that you can give them to make a first prototype, or to think about their IP strategy, or to think about how do you get a patent for this, and how do you do that. So there's certain questions that you don't have when you just do software SaaS businesses or B2C businesses in the software space. But that's become I think part of our brand is that we don't shy away from moonshots, from difficult things, from things that need original thinking and that sort of, are very different to what other people do. And some of those businesses, so there's another example. So business of 3 co-founders, a serial entrepreneur, a nanophysicist, and a race car engineer. They've built a business together called Neum, and they make green ammonia. So they take currently the process to make ammonia is something called the Haber-Bosch process. It's a very, very, very highly energy intensive, very emitting process. It's very bad for the environment. And you go from hydrogen to ammonia. And they have found they've created a nanotechnology that helps that process in a low emission, low energy, low temperature, low pressure. Yeah, I mean, they needed to validate this first step, and then they needed people to understand this technology and be able to say, well, yes, it is very early, but yes, this can work. If you do these things, this is the kind of things that you have to do, and then you can prove what are the next steps, right? The proof points of a biotech startups are very different to the proof points of a software startup. You have different milestones. It's a bit more not regulated, but it's a bit more set. Like you go from technology readiness level 3 to 5 to 10.
Let's go through this funnel in terms of time period of your founders. Like this first period, you say that it takes 10 weeks, right? And then like how long is the second period? When usually companies got funding, and what is average size?
First phase, 10 weeks. Then there's a 2.5 months time period where, so about 80% of the cohort find a team. So of the 80 individuals, 50, 60 go on, find a team. And so that means we have somewhere between 20 and 30 teams. In the beginning, it's often more around the 30 mark. And then some teams realize, actually, this is not working for us. And there's a bit trial and error. Like you have to, as a team, you actually have to start working on something to see how your co-founders react. And then we make the investments after roughly 4.5 months. And then we work with the teams for another 4 months to get them investment ready for outside investment. At the end of which there's a showcase day or demo day. The next one is on the 24th of January in Berlin for a German cohort. We'll have actually a streaming option. So for any listeners, if they want to join, there's a streaming option that's open to everybody. And then there's an exclusive investor-only event in person. We're being hosted by the Google headquarter here in Germany, in Berlin. That's the official end of the program. But as Carbon13, we have these programs, and then we have a venture fund. So we have a fund that invests in the startups, and that fund then also does follow-on investments in the future. So I said we've invested in 65 startups. That's about £7.5 million, let's say about $10 million that we've invested so far. Part of that comes from the first close of our LP fund. So we're raising a £30 million fund. At this point in time, definitely interested to anybody who wants to invest in that fund. We've done a first close with some fantastic family offices, VC funds in the UK. I don't think I can mention them publicly, but there's some really great people on board. And we'll be aiming to close that fund entirely by maybe this time next year, early 2025. So end of next year / 2025. I think the official timeline is early 2025, but I hope that we'll be able to close it sooner, because there's a lot of interest right now. Given the 65 startups that we invested in, there's quite a few early winners. There's startups that have gone from, to give you an example of a startup that really has been able to accelerate the whole process. We kicked off our second cohort in September 2021, at which point we had a team come together. There was a team of two, Thomas and Paul, that met each other that knew each other from before. They had built a business. One of them had built a business and sold it. And then they got to know each other, and they met their co-founder in the program. And the co-founder had been spending time selling to insurances and selling in a law firm, selling to insurances. She saw that there was this gap in the market, which was that, everybody was speaking about carbon credits in 2021, but there was no insurance for carbon credits. There was no way for corporates to insure those carbon credits that they were spending a lot of money on. And actually, there's risk with carbon credits. So you should be able to insure it. Whenever there's an insurance, you can give a price signal to a market to say, this thing is more risky, so your insurance premium is higher. This thing is more secure, so your insurance premium is lower. And together they built a company called Kita, We invested in February 2022. They then went on to raise another. So we always invest £120,000. Actually, we're currently planning to put that up slightly. But so in the past, we invested £120,000. They then went on to raise another 250K, around that number, a few months later in 2022. And by the end of 2022, they had raised £4 million from a UK generalist VC and some climate and insurance sort of corporate VCs. So that's a really good example of like, you go from the first time the founders meet to a 4 million round in a year, or actually a bit, maybe even less than a year, in terms of the whole funding process.
Maybe you have some figure in your mind, like how many investments the whole portfolio got from outside investors.
Oh, wow, that is a very good question. Of 65, so we've made 19 investments in September/October. So it's a bit early, but actually 4 of those already have raised money from some really good VCs. Of the 44 before, I would think that the number, I would need to look up the number, but it's about 80% of those have raised angel money or VC money. In some cases, they have gotten, like in the UK, we can help them a lot with government grants, so non-dilutive finance, especially for the hardware startups. That is, I would say, a very important part of their capital stack. And we have a close partnership in different ways. So we're an investor partner of Innovate UK. So we can help with grant funding. Obviously, there's still a process to go through, but we can recommend a lot of programs and know a lot of things which are going on.
So you not only attract some entrepreneurs with previous experience, and not only some deep tech people, scientists, but also some, I don't know, marketing specialists willing to do a company in this field, right?
Yeah.
And they also become co-founders. Do they get equal shares, or it is different?
So we don't tell the teams how they should distribute shares. There's a good argument to be made for distributing shares equally. And there's a good argument to be made that, one person should have more. It depends on the composition of the team. It depends on quite a few things. I personally, sometimes I'm more in favor of equal shares, but I've seen both work. It's an interesting question. We should look at the data of what works better.
I remember some time when I was reading the book, probably The Great CEO Within. And also at the same time was going through Y Combinator startup school, probably. On Y Combinator, they say only do equal shares, so no other way. So you'll do it. And in the other book, I read something like, not do equal shares, never.
I don't think there's a right or wrong. You kind of have to agree as a team what you're happy with, and sometimes you have people. We do have the situation sometimes where somebody says yes, and especially academics, you have a sort of, I still have one day a week that I want to do something else. I'm teaching, or I'm like doing research, and that can be valuable for the startup. And there's other people that are in there full time, and then there's obviously a difference. But I think being pragmatic is really important in these things. And as long as you don't do things that look weird and look out of place, then I think you're fine. Don't do 90% and 10. That's a bad idea.
When you get 10% shares or less percent shares, like after when people enroll in your 2.5 months, do they sign something like, if we launch a company, then we'll go through Carbon13? And when an accelerator, when your fund invests in those companies, like also like what are terms? Or how much shares additionally do you get if you have some valuation?
If we invest £120,000, we get up to 10% of the business. That's the total. There's an element where they give us a small number. It's slightly split into what the fund gets, which is like 90% of that, and then there's a small percentage to the venture builder. But it's very much weighted towards the fund because the fund needs a certain return profile, and the fund also then does follow-on investments based on we do get super pro rata rights in future rounds where we want to be more supportive than maybe our initial 10%. But that's because we're still in the process of raising this first fund. We haven't done fund investments in many future rounds. We've invested in some future rounds, but more through an SPV structure.
Like when people enroll, they sign something like an option or not that you can invest.
Yeah, exactly. Yeah. So I mean, that it's necessary just because, and it's only if they meet a co-founder. Right? If they don't meet a co-founder, if like you come in and then you don't meet somebody and you leave again, then we don't really. But yeah, if two people meet, that's where we see we have added value.
Were there some cases when they found an external co-founder and say something like, I want to bring another co-founder to the program, something like that?
Yeah, absolutely. It's definitely, it's almost in every cohort, there will be somebody saying, hey, I actually have this external person that because a lot of the people, if you think that those 50% that have committed in the past and that are already like going through this sort of, I want to build a business, they oftentimes have conversations. They have, they go out in the market, they present their idea, they find a potential co-founder. I guess the difference between us and other programs is that we don't believe it has to be two. So I know that Entrepreneur First says it has to be two people. I think especially in the biotech space, it can be very helpful to have this mix of a machine learning, artificial intelligence person, a scientist, and a commercial person. So you have this like very interesting mix that can create something that really changes the status quo of how you do things, and not just does a small thing.
I remember some statistics that like having 3-4 co-founders gives you 78% more chances to create a unicorn, and having one co-founder, I don't remember the exact, but something like it. Probably 38% less than the average. So like three or four co-founders increase the opportunity to create a unicorn. But if you will divide those like for each founder, it probably like they can earn a bit less.
It's a very interesting stat. And I mean, we believe that, and I can see from our statistics, like teams of 3 are probably more likely to keep going. I guess like, just realistically, like we've had everything from one team that we invested in where somebody got really ill and couldn't work anymore. But then if it's 3 people, there's still 2 people that can keep going. Or we had somebody who had another reason. Like there's always reasons that happen. If you have a big enough number, something will happen. Teams of 2, I think it's hard. Startups are really hard, and keep going by yourself is sometimes, even though we've had that situation as well, where we've had teams where the team has broken up, one person kept going, and that person is now actually doing really well, raising a very large round of funding, because she's just a very strong CEO. And yes, she's lost 2 people, but then she's hired other people, and now she has not co-founders, but she has other C-level people that that manage the business with her. It's probably 3 or 4. I think teams of 5 is probably not a good idea, because it's just too many. It's too many mouths to feed from a initially small amount of money, right? If we give you 120 and then maybe you raise another 100 to 500, it's just hard to pay salaries in the beginning already, and like splitting shares. If you then do equally 20, 20, 20, like 5 times, that's probably a bad idea.
So you invested in 65, 85 probably you also have options, but not invested. So like you don't have shares there, or you have some shares?
We have some shares, but then also a lot of them don't exist anymore. I think the ratio there is quite high, that the teams that don't keep going.
Let me understand like how you were able to start this, like how much capital you invested or attracted, what is your structure? Of course, I understand like dual entity model, something like venture builder holding company, providing some services for and getting some small percentage of equity, and also a fund getting the majority of those 10% equity.
Exactly.
But maybe you can share like what was the initial process? How many people actually is in your team?
So I was one of the co-founders. So at the time we were three people, 4 people. Very soon there was, so we were lucky that my co-founders were able to access some corporate financing very early on. So there was a corporate BP Ventures who gave us money very early on. And they said, we like your model and we want you to do this. Not on day one, but very early on that they gave us some money. There was also VW who gave us support very early on. I think they liked the idea of these decarbonization projects and wanted to support that. We then went on to raise a fund. And I think if I was to build this again, maybe I would do it the other way around. I would raise a fund and then do the model personally, maybe if people are getting started now. Obviously, raising a fund is very difficult if you've never been a VC before. So there's a catch-22 here, but
and like because you can provide more value for those entrepreneurs and better entrepreneurs join, or what is the reason that you would start with a fund?
Because you absolutely need the fund to invest in the startups. If 2 or 3 people that know startups that have been a founder before, you could run a program that helps people start something, and then you invest in some of the startups, and then you get some money, and then there's this sort of, then the flywheel starts working. If you don't have a fund, yes, you can. I mean, in many European countries, actually in Germany, for example, there's a lot of incubators that are paid for by the government, and they don't have a fund, but they give a government grant. And I guess that's another model where and I guess in the US, I've seen this before as well, where you have government money being given to the startup as a grant rather than an investment. And that government program often then gives a certain percentage of payment to the employees of the venture studio or the venture builder. So I think that maybe is actually a very common model if I think of Germany, as well as the UK that I can think of in the US.
How many people are in your team?
We are 15 people full-time. So that's 4 people here in Germany, where I'm based at the moment. And then the rest is in the UK working on the sort of, I guess, there's the company operational, like finance and HR and those kind of like general company functions. And then there's the people looking at the programs, both the venture builder in Cambridge and the accelerator, what we call the venture launchpad. There's also a fund team that's looking after the fund and the portfolio. We do have a fairly large set of people that contract for us. So these entrepreneurs in residence, it's that's another group of probably 10 people that do a certain number of hours with each of the teams, and we pay them. It's not a cheap model, right? Like I think as a VC, it's a lot easier to have 2 or 3 people and that's your whole staff. I think as a venture builder, if you can provide a very deep level of support across different categories, I think the more you can customize that support to the different teams, the better. But that means you need to have a lot of people with different expertise areas and so on. So something that's interesting is when you run cohorts, you get these you almost have like vintages. So VC funds always talk about vintages, and we have vintages of cohorts, and then we can see TVPI or return on investment for those investors quite early on. So we actually have really strong TVPI of 2x and more for some of our investors in our 2-3x for investors in these vintages that have, because we would have in the beginning we raised a fund per cohort, and that's something that's easier to do in the UK because of the way you can structure very small funds, like micro funds of sort of 1-2 million pounds. SPV. It's not an SPV. In the UK, they've been doing this for a long time, so there's a lot of different structures you can use. It's not an SPV. It's a semi-fund I think officially it's a contractual agreement between the company the investor, a company that does that brings the deal, and then the company that you invest in, and there's a contractual agreement between.
So you raised several of those, or not?
Yeah, we raised several of those, and then now went into this LP fund where we now are raising 30 million. And a normal sort of general LP GP structure.
How many funds did you have?
We had 4 small ones and now one bigger one.
Each fund of those previous funds was amount like 5 million? 3 million?
No, so about 1 to 2 million. So very small.
Uh-huh.
I think another thing that, like, being close to corporates and having corporates give you some money, it can be a real win-win-win. So for the corporate, they might get, they basically are looking for innovations to certain problems that they might be facing. In, let's say, in our case, it's decarbonization of their supply chains, or decarbonization of their products, or finding ways to make the business lower their emissions overall. We can help with these kind of innovations. There's also the startups, they get access to customers earlier, they get feedback earlier and faster. And then obviously there's an element of financing the running, the operational budget of the venture studio, the venture builder. So that's something that's been very successful for us. And we've got some great partners with, for example, Arm, who have a strong interest in AI and embedded AI and a lot of these different sort of hardware, software combination startups, as well as EY, who are really looking for a lot of ways to help their customers decarbonize. So there's a huge opportunity there. So that's an element that I wanted to say as well. And then I do think this sort of impact space makes it maybe a bit more interesting to join a venture builder for a founder that is maybe otherwise too experienced, or very experienced and maybe too experienced to go through another program. Because if they were to just build something where they had already made money, let's say SaaS, some kind of SaaS business in retail, and they want to just do another business, then they wouldn't go through a venture builder. But because they want to make the switch to a space where often it's a mix of hardware and software, and it's maybe a different customer group, that's where we think we had a lot of value in helping them find a new tribe, a new community. And so I do think this climate impact, climate focus means we do get better founders on average that maybe otherwise wouldn't go through a venture builder.
Niche expertise helps also to distinguish bad ideas, good ideas, and reuse partnerships and customers. Yeah,
absolutely. Yeah, absolutely. I mean, the more experienced your founders, I mean, there's some, as long as they're excited about something new, right? Like there's some founders that are maybe a bit jaded, and they don't want to do something new, or like are very set in their ways, and that can be a bit tricky. But I think people that are open and want to build something new and want to learn and sort of be part of something new, rather than just being the one person that dictates everything. I think, those people, that's ideal. Yeah, so that's an element that I wanted to say as well. And then I do think this sort of impact space makes it maybe a bit more interesting to join a venture builder for a founder that is maybe otherwise too experienced, or very experienced and maybe too experienced to go through another program. Because if they were to just build something where they had already made money, let's say SaaS, some kind of SaaS business in retail, and they want to just do another business, then they wouldn't go through a venture builder. But because they want to make the switch to a space where often it's a mix of hardware and software, and it's maybe a different customer group, that's where we think we had a lot of value in helping them find a new tribe, a new community. And so I do think this climate impact, climate focus means we do get better founders on average that maybe otherwise wouldn't go through a venture builder.
Niche expertise helps also to distinguish bad ideas, good ideas, and reuse partnerships and customers.
Absolutely. Yeah, absolutely. I mean, the more experienced your founders, I mean, there's some, as long as they're excited about something new, right? Like there's some founders that are very, maybe a bit jaded and they don't want to do something new, or like are very set in their ways, and that can be a bit tricky. But I think people that are open and want to build something new and want to learn and sort of be part of something new, rather than just being the one person that dictates everything. I think, yeah, those people, that's ideal.
Yeah, thank you, Michael. This was very interesting, interesting model. I'm very happy to interview you.
Thank you. Yeah, it was really interesting, your questions. I can see you have, you know the things to ask for.
Every time, like a startup studio, when you're doing every next startup, you get some expertise and understanding. So the same with understanding of the model.
Cool. Well, yeah, thank you very much for having me. And yeah, this was an interesting conversation.